Welcome to the deep dive. Today we're really focusing on Berkshire Hathaway. The stock's been hitting some serious highs.
Yeah, an all-time high, actually, just before their big annual meeting.
Right, which makes it a really good time to, take a closer look what's going on under the hood.
Absolutely. And that peak, it brings up a key question, especially for you as an investor. We're looking at a piece from the Motley Fool, and they ask, basically, with operating earnings actually down a bit, is this classic value stock still a smart buy right now at these levels?
Exactly. So that's our mission for this deep dive. Get past the headlines, the sheer size of Berkshire, and really understand what's driving things. We'll be using that Motley Fool analysis looking at the Q1 2025 results.
And Buffett's comments, too, from the meeting.
Right, and try to figure out, does Berkshire Hathaway still make sense for your portfolio?
Okay, so first off, that stock performance, it really jumps out.
It really does.
That high on May 2nd, it wasn't just a blip. Year to date, we're talking up 14%.
Which is huge when you think the S&P 500 is actually down, 4.5%?
Exactly. Quite the contrast.
And it's not just this year, is it? The article points out this is the longer trend.
Oh, yeah. They've beaten the S&P over the last 3 years. And get this, over 5 years, Berkshire's nearly tripled.
Tripled, while the S&P doubled. That's serious outperformance. Makes you ask why.
And that's where it gets interesting, because the shape of Berkshire has been changing quite a bit during this run-up. You can basically think of their assets in 3 main piles.
Okay.
You've got the businesses they own outright, the controlled ones, then their stock portfolio, the public equities, and then, well, just cash. Lots of it.
And those piles have shifted, right? Especially to cash.
Oh, dramatically.
Yeah.
That cash position, end of March 2025, it was $347.68 billion.
Wow.
Just compare that to March 2022, it was about $106 billion then.
That's a massive increase. What do you think that signals, sitting on that much cash?
Well, it could be a few things, couldn't it? Maybe they're cautious about the market overall. Maybe they just don't see big, juicy acquisitions at the right price right now.
Or maybe saving up for something big down the road.
Could be. It's definitely a safety net, a huge one. But, there's an opportunity cost too, right? Especially with inflation being a factor.
Good point. And on the other side of that coin, their stock portfolio, the public equities, that's actually shrunk.
Yeah, it has. As of early May 2025, it was valued around $277 billion. Back in March 22, it was closer to $390 billion.
So less exposure to the wider market, more cash.
Right. Which brings us to the third piece, and this is maybe the most important shift. The value the market seems to be putting on their controlled businesses, the ones they own outright.
Okay, how's that measured?
It's an implied value. Basically, analysts estimate what those businesses, insurance, railroads, energy, etc., would be worth if they were separate public companies. And that number, it's soared.
How much?
According to the Motley Fool's take, as of May 2nd, 2025, it's estimated at $537.9 billion.
Whoa. And compared to 2022?
Back then, it was around $282 billion, so it's almost doubled in just a few years.
That's incredible. And the article says this isn't because they bought some giant new company.
Not primarily, no. I mean, they upped their stake in Berkshire Hathaway Energy. They bought Allegheny for, $11.6 billion. Those are decent moves, but they don't explain that kind of jump in implied value.
So it really suggests the market is seeing more fundamental value, more strength in those core own businesses themselves.
Exactly. It looks like a re-rating. Maybe the market likes the stability of those earning streams more now. They tend to be pretty resilient, through different economic cycles.
Okay, resilience. But what about actual performance? Because the Q1 2025 operating earnings, the headline number, was actually down 14% compared to Q1 last year.
Right. And that, that might make you pause, but you have to break it down.
Where did the drop come from?
A big part was insurance underwriting. It went from about $2.6 billion in Q1 24 down to $1.3 billion in Q1 25.
Okay, that's a hefty drop.
It is, but the article makes a good point. 2024 was an exceptionally good year for underwriting. Fewer big disasters, maybe. So this could just be things getting back to normal. Insurance underwriting, it's naturally bumpy.
Volatile. Okay. But there's another part to the insurance business.
Yes, the investment income side. And that part was actually up slightly, from $2.6 billion to about $2.9 billion.
And that's driven by the float, right?
Exactly. That's the key. The premiums they collect up front but haven't paid out in claims yet, it's like a giant pool of money.
That they get to invest for their own profit. Basically an interest-free loan from policyholders.
Pretty much. And based on that Q1 income, The Motley Fool figures they're making about a 6% annualized return on that float, which is, pretty nice steady income.
Okay, so insurance underwriting was down from a high, but investment income was up. What about the other big pieces? BNSF Railroad.
BNSF was pretty steady, up just a tiny bit. Berkshire Hathaway Energy, though, that saw a decent jump in earnings.
And the manufacturing and retail businesses.
Also pretty stable. Not much change there year over year.
So it sounds like the main drag on the overall operating earnings was that insurance underwriting normalization. And then there was another category that fell sharply.
Yeah, that other bucket dropped quite a bit. The analysis suggests that's sensitive to things like currency swings, interest income, stuff that moves with the broader economy.
Okay, so if you put it all together, despite the headline drop, the core-owned businesses, the railroad, energy manufacturing, they seem to be doing okay, or even growing in some cases.
That seems to be the picture, yeah. Which lines up perfectly with how Warren Buffett talks about the company, doesn't it?
Absolutely. He always hammers home that long-term view. He's not sweating quarterly numbers.
Right. He's asking, where will Berkshire be in 5, 10, 20 years? It's about patience.
The kind of patience that feels pretty rare these days.
It really does. So the big question then, for you listening, does Berkshire make sense as an investment now?
At this all-time high.
Yeah. The Motley Fool article kind of lands here. The stock's big run-up seems mostly tied to the market appreciating those controlled businesses more. Their earnings are growing at, quote, a good pace, but...
But maybe the stock price has run up faster than those earnings. It's not the bargain it used to be.
That seems to be the implication. Maybe less of a screaming deal than it once was.
Okay.
However, they still suggest it could be a decent buy, especially if you're a patient investor.
What makes it decent then?
Well, two main things, really. That enormous cash pile that's a huge safety buffer, and the focus on those stable, wholly owned businesses.
Right. So for someone maybe a bit more risk-averse, that cash cushion looks pretty attractive in uncertain times.
Definitely. But you also have to consider that rising valuation. The price has climbed, maybe faster than the core business growth recently, so you're paying up a bit for that stability.
A trade-off, then. Potential premium for perceived safety and long-term focus.
That's a good way to put it.
Okay, so let's try to wrap this deep dive up. Berkshire Hathaway. Stocks at a peak, largely because the market loves its owned and operated businesses more than ever.
Even though overall operating earnings dipped in Q1, mostly due to insurance underwriting normalizing.
The core businesses seem solid, strategy shifting more towards them, and they're sitting on a mountain of cash.
Which leads back to the ultimate question, should you buy it? And the answer seems to be, well, it depends.
Depends on your time frame, your comfort with risk.
Exactly. If you're thinking long, value stability, and like that cash safety net, then yeah, even at this price, Berkshire probably still looks pretty compelling.
Okay, so a final thought then, something for you to chew on. With Berkshire focusing more internally on its own businesses, holding all that cash, maybe less on public stocks, what's the next big move? Could a future acquisition, maybe one driven by Buffett's successors or some internal growth push, dramatically change Berkshire's earnings power over the next, say, 10 years?
That's a great question. What could they do with all that potential firepower? Something definitely worth considering as you think about its long-term place in your own strategy.
Absolutely. Well, thanks for taking this deep dive with us today.